Well, traders are braced for a monster week ahead. We've already had a surprise rate hike from the Reserve Bank of Australia in the early hours of Tuesday morning, and the week just gets busier from there. The FOMC on deck on Wednesday, expecting one more hike, and then that'll be it from Jay Powell and co. over in Washington, D.C. As the week rolls on, we get a hike from the ECB, we get a hike from the Norges Bank, we've got PMIs, we've got Apple earnings, we've got a busy data docket, and also the week wrapping up with the huge US labour market report on Friday. There's always plenty for Ryan Littlestone and I to discuss on the trade-off. There's more than normal for us to discuss this week. So without further ado, let's get into the show. Well, it's a busy show this week, so let's not hang around. Let's bring in Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, we've had a long bank holiday weekend to recharge our batteries. It's a monster week ahead, isn't it?
Yeah, definitely. More fireworks today with the RBA going with a surprise hike, which pretty much caught everyone off their guard. So plenty of surprises to come this week, no doubt.
Yeah, most definitely. I think the RBA have almost achieved the impossible overnight and actually made the Bank of England behind you there look somewhat competent, which is a very, very tough ask indeed. But as you say, I do think that somewhat sets the tone for what could be a week of surprises and twists and turns as the next 4 or 5 trading days progresses. So let's get into it in Topical Thunder. Well, I want to start with the Fed. There's plenty of risk on the horizon this week, but I think the FOMC is by far and away the marquee event of the week. Fully expecting a 25 basis point hike from Powell and co. on Wednesday evening, but also expecting that will be probably the last hike of the cycle. I think it's a bit of a long shot that we get explicit guidance to that effect. We've obviously had the Bank of Canada have hit pause, the RBA, funnily enough, hit pause and then took their foot off the brake pedal once again. And they were very, very explicit in doing that. I don't think the Fed will be following a similar playbook. I think instead they're probably going to just repeat the guidance that they've used since the February meeting in terms of saying that further tightening may yet be appropriate. But I think everyone, when you look at market pricing, when you listen to what sell-side economists are saying, pretty much every man and his dog is expecting we get one more hike and then that's it. But interestingly, I think there's a decent chance actually that we may get a dissent this week. We've had some very, very dovish commentary recently from the president of the Chicago Fed, Austin Goolsbee, and I wouldn't be at all surprised if he voted in favour of rates remaining unchanged. But by and large, the majority of the committee should vote for a 25 basis point increase. I think optionality and flexibility is really going to be the name of the game when it comes to Chair Powell at the press conference. You've got to remember, between Wednesday and the next Fed meeting, we've got 2 labour market reports, we've got 2 inflation releases, and a whole host of other economic data alongside that. So plenty for the committee to digest between the May and the June meetings. But I think fundamentally we're now moving into a different phase when it comes to the FOMC. Recall sort of the middle of last year and also the tail end of last year as well, the guidance was rates going higher than market participants expected for longer than market participants expected. We've now pretty much done the higher part. Rates are going to be at 5 to 5.25%. We now move into the longer part. And I think that's where we really get into the potential for decent volatility, because of course markets continue to price around 50 basis points worth of cuts between the terminal rate and the tail end of the year, despite the fact that core inflation remains above 5% and has done every month since December 2021. I think really we're now in a case of how long does the market continue to price rate cuts for? And also, how does that resolve itself? Who wins? Is it the Fed or is it the market? Personally, Ryan, I'm coming down on the side of the Fed.
Yeah, definitely. And, I don't think the Fed can do what the RBA did. They paused for, relatively short period. The Fed can't give that sort of message where they're jumping in and out, rate hikes, pauses, rate hikes, pauses. So I think definitely we're going to get a hike, but I wouldn't be surprised if they firmly keep more hikes on the table and maybe not give such an indication of a pause. They may sort of try and make it a bit more finely balanced, but they're not going to, based on the other central banks, they're not going to say we are on pause now, but we may hike. I think they're going to keep hikes well on the table, continue to do so, and really push that message of keeping rates higher for longer, because inflation is still sticky. And I think that's the part that you've mentioned that the market is struggling with, that keeping them higher for longer. And, pricing in cuts towards the end of the year, really got to see the economy collapsing. And, that's just not happening even coming into the first quarter, which I'll speak about shortly. So, yeah, I think the Fed sticks with their message, but I think they're going to perhaps reinforce that and not take further hikes off the table that much as maybe many in the market expect.
Yeah, I think that's a very good point. I think you've got to recognise that actually the risks to the markets are for a hawkish surprise, I think, out the FOMC. Pretty much, as I said, everyone is expecting a hike, and then that's pretty much it. Well, actually, if Powell comes out again and is very aggressive and very resolute in terms of the desire to get inflation under control, that's obviously going to put a big bid in the dollar and be a fairly chunky headwind for equities as well. You alluded to this, the market struggling with this for longer part, and it's actually starting to annoy me a bit now. And, frequent viewers of my commentary will realise that doesn't take particularly much. But it's getting to the point where everyone is saying the average time between terminal and the first cut is about 6 months. Yeah, that's fine, but you've got to realise that over the last 3 or 4 decades, we've had an environment where everyone's been saying inflation is too low and trying to stimulate demand. We're now in the total opposite of that. Inflation's far too high. We're trying to get reduce demand and get inflation back under control. So I hate to say this time is different, but I do genuinely think that those betting on the Fed cutting 6 months after getting to the terminal rate are probably going to be misplaced this time around.
Yeah, I think so too. And as I say, it's going to need something to turn. I mean, inflation can pull back, pretty sharply. And I think we should expect to see some of that happening over the months ahead. We've seen it in Europe, where somewhere like Spain, 1 minute they're at 9%, the next minute they're at 6%, and we're seeing a lot of volatility in these inflation numbers, and I think that's going to continue. But I think the big key point is that inflation rising at a lower pace is still inflation rising. It's not. We're not seeing any negative numbers. We may have started seeing some in some of the PPI data, where we're actually seeing negative month-on-month, negative year-on-year numbers. But still, this is inflation growth. It's just not grown as far. But when you're still seeing inflation 5, 6, 7%, or still up 9, 10% in the UK, we're far from through this yet, and that's what's going to be at the back of central banks' minds.
Absolutely. Just the last point on that is obviously, especially as we move into the spring and into the summer, base effects from last year, Russia invading Ukraine, commodity prices going through the roof, they're going to massively depress the year-on-year numbers. So I do think, as you alluded to, the month-on-month prints, if you do a 3-month average or you annualize the month-on-month data, I think that's probably a bit of a cleaner way of trying to gauge where underlying price pressures are. And it's probably something that central banks are going to start doing as well, in terms of trying to get a little bit of a less noisy read on exactly what's happening with inflation and how the lagged impacts of what they've done are actually feeding through to the economy. And of course, one place where those lagged impacts haven't really been felt yet is the labour market.
Yeah, the labour market, and here we are again guessing when the jobs market's going to collapse. It's the same old story, isn't it? We do this every month. Wherever we are, is this the month where the jobs market turns? So we're still waiting for that domino to fall. And, aside from central banks, we've got a ton of data coming this week, as you mentioned, including plenty of employment data leading up to the NFP. So I've just highlighted a couple of prints to keep an eye on ahead of the big NFP. Now, first up is JOLTS, which dipped below the 10 million level for the first time since way back in May 2021. And that may be the first sign that employers are finding things a bit tougher and they're just scaling down their hiring patterns or what they're looking to do. So that's one to keep an eye on, because the market's going to jump over that. It's a bit of a lagging indicator. It's a couple of months behind everything else. But one point you want to look for that is the quits number. Now, the quits number can be a good indication of people trading up jobs. So people feeling confident that they can leave a job and look for a better paying job or better, career change or whatever. So the quits number can be an important one. It's been doing pretty well over the last few months. So that suggests that, the market is healthy. If we start to see something like that pulling back sharply, that suggests that maybe people are a little bit more nervous to change up a job, to look for that better paid job, and they're going to stick where they are. And that's just a little indication. As I say, maybe there's some nerves among employees okay, I'm going to be glad to have this job for them now because there is uncertainty, so I'm going to stay where I am. The second data point is the ADP, which is a real funny one. It's not really much of a weather vane for the NFP. Every month, the market looks at it. If there's a big variation there, it makes some adjustments to its NFP expectations. So that's can always be a volatile number if we get a big variation. It's not, as I say, not really a big weather vane, but it's important to look at the components within. It gives you a breakdown where the jobs are or have been lost. Manufacturing, leisure, hospitality, that sort of thing. And it does a pretty good job of breaking that down. So again, look at the sector changes that might be seen there. We know that manufacturing has been a bit soggy in the PMIs for recently, more so than services. So is that an aspect we're going to see in the employment numbers coming through there? The third one is a data point that not many people look at, really. It's the Challenger Graham Christmas layoffs report. Now, it's not often watched, but it is rising. It has been rising quite dramatically over the last few months. A year ago to this very month, we're running around 30,000 layoffs. Now, the last three readings have been 103K, 78,000, 99,000. So they're picking up a bit. Now, a lot of these layoffs are mainly down to the tech sector, which we know there's been some, big layoffs over the last few months. But it's important also to know that layoffs that are announced don't necessarily mean those are going to be job losses. It's an intention, like when Amazon says we intend to lay off 8,000 people. It doesn't mean all those people will go, but that's what appears in this report. So again, it's a good report to watch the areas that people are being laid off. Are there certain sectors that are being affected more than others? And if these numbers continue to rise, continue to gain, again, it shows that there's maybe some issues in the labour markets that we're not yet seeing in the main numbers like the NFP.
No, I think you're absolutely right. It's a huge week for the labour market. And as you say, we seem to talk about this every month where we go, is this going to be the month where payrolls go negative or where we see a big rise in unemployment or earnings growth cools off and we really start to see some signs of the labour market softening? And it just doesn't seem to happen. And there's no real sign, I must say, in the leading indicators that we've already seen, such as the jobless claims numbers. There's no huge sign that things are going to fall off a cliff anytime soon. I know jobless claims have risen, but there's some issues with the seasonal adjustment going on there. The ISM manufacturing PMI that we had yesterday, you said rightly that the manufacturing sector has been underperforming compared to the services sector, but actually the employment index back into expansion at 50.2 in that ISM manufacturing number yesterday. So that's a promising sign. And it really is a case of wait and see, I think, with the labour market. But importantly, in terms of policy implications, the longer we see jobs growth bubbling along nicely between sort of 150 and 200,000, unemployment remaining somewhere around the 3.5, 3.6, 3.7% mark, and importantly, earnings growth remaining somewhat capped, about 1/3% month on month, and participation at or very, very close to cycle highs. The longer we see data like that, the less reason there is for the Fed to even consider loosening policy. And again, it comes back to that point we made earlier. The longer the labour market holds up, the longer rates are going to stay at their terminal level. And of course, that's something that the market hasn't really got itself to price in just yet.
Yeah, exactly. And I think that's going to be our key indicator for when central banks might start cutting rates, particularly the Fed. If the labour market does tip over 3, 4, 5, 6 months down the line, even sooner, then you're going to get those expectations for cuts coming up. If that impacts the economy negatively, more so than we're seeing now, then you can start talking about cuts. But still, cuts are only going to be bringing the rates down to a neutral level. We're not going back to QE, negative rates and all that palaver. So, people need to keep those expectations under control as well.
Yeah, very important to remember that. The Fed spent last year saying we want to get rates into restrictive territory. That's where we are now. A couple of cuts just gets us back to that neutral level. It's not really easing in the truest sense of the word. So that's a very, very good point indeed. A central bank that's not really thinking about rate cuts at any point in the near future is the ECB. We're expecting another rate rise out of Frankfurt this week. We obviously had 3 50 basis points hikes in a row, as as Christine Lagarde promised us last December as a nice Christmas present to us all. That's now done and dusted, but it's clear that we do need further tightening in the Eurozone, and actually even the most dovish members of the Governing Council. You think about people like Philip Lane, the chief economist. He is known as one of the most dovish members at the ECB. Even he is saying that more hikes are needed, and note hikes plural, importantly. So the market fully expecting a 25 basis point hike from the ECB on Thursday. I think the risks to that are actually skewed a little bit more hawkish. And probably between the time of me saying this and you watching this video, we will have had the latest bank lending survey from the ECB. And we'll also have had the latest inflation data referencing March. And if we see another all-time high in that core inflation print, and if the bank lending survey points to the fact that actually all these banking troubles haven't had too much of a pass-through into more restrictive credit conditions in the bloc, then that may embolden the hawks on the Governing Council a little bit to try and push for a larger 50 basis point move. Although I must say that that's not my base case. I think it's important to note that underlying growth in the Eurozone is actually all right. If you look at some of the PMI indicators, the services and the composite gauges, they're both at their highest levels in a year, which is giving the ECB this freedom to continue raising rates and to maintain their hawkish tone. And unless and until, very similar in the United States actually, but of course we expect the Fed to hold, unless and until we see core inflation coming lower and earnings growth in the Eurozone beginning to cool off, then I think it's very, very hard to make the case for the ECB pausing or halting their rate hikes. And I think it pains me to say it, but that widening divergence between the ECB and the Fed should continue to support the euro. And it looks at the moment that actually the ECB are going to be the last hawk in town when it comes to G10 central banks.
Yeah, that could well be the case. I think a 50 is a bit of a higher risk than maybe a lot in the market are expecting. But I also think that maybe the last 50 was a bit of a concession, and that, we should go 25. But I think you're right. I think the message that's going to come out is, okay, yep, we've gone down to 25, but we're prepared to now have a string of 25s if need be. We're not close to a pause with the ECB at all, I don't think. So, yeah, while that was maybe the last 50 was a bit of a concession, as you mentioned, even some of the doves are coming out saying we still need to keep hiking. So I think it's going to be a case of, if they move to 25, they're going to continue that. They're not going to give an indication because the guy got told off for giving us those 350s as forward guidance. And there's been plenty who have given a slap round the wrist for that one. But the message is going to be, we're going to continue hiking. And, we're going to have to look at those next set of forecasts when we get them, because everything is based on the March forecast if those come to fruition. And at the moment, there's no reason to say they won't.
Yeah, absolutely. I think those June economic forecasts are absolutely key. One thing that I'm a little bit surprised we haven't heard more on, and I've been guilty of not mentioning this myself, is actually the ECB's balance sheet. They announced, well, I guess you can call it quantitative tightening. It's not a particularly aggressive or rapid pace of balance sheet runoff, but I'm surprised we haven't heard more in terms of quickening that up or tweaking that in somewhat as another concession to the hawks, as you mentioned. And I just wonder whether that shows a little bit of a degree of concern among members of the Governing Council that, although they've obviously been comfortable raising rates to the degree that they have and at the speed that they have, I just wonder whether there's some lingering concern in there about Eurozone debt markets and whether perhaps there are still some fragilities and some shakiness there that means that although we're seeing these rapid rate hikes, they're not entirely comfortable with pulling themselves out of the market entirely.
Yeah, I think the liquidity side of things is still a big play for the central banks at the moment. We saw last week they did draw down their swap programs. A lot of central banks were doing offering them daily, brought them down to weekly. The fact they still do offering them weekly suggests that, they're just keeping their finger on the pulse in terms of all these banking problems and potential liquidity issues. But a lot of people are saying, QT is going to be, ramped up from June perhaps. So we may get a bit of an indication on that at this meeting. But in trading terms, it's not really a big deal. Yeah, it can be seen as tightening, and if they ramp it up, how much they're going to do QT by. But the reality is the market is really focused on rate hikes. But if they give an indication that they're swapping rate hikes for QT and doing it that way, well, then we've got a different story.
Yeah, very much so. And just lastly on the ECB, I think you've got to remember that big policy changes come when they release their staff macroeconomic projections. This week, they're not releasing any staff macroeconomic projections. So for me, and I think most in the market, it's 25, risk of 50, stay hawkish. And obviously, you've got that tail risk of Lagarde having a howler at the presser as usual. What about global growth, Ryan? It's an interesting one for sure.
Yeah, well, we're speaking about growth, and we've had the first prints for the first quarter this year, and it's been really important to watch these because it tells us, are we heading for soft landings, crash landings, so on and so forth. And they've pretty much gone as I've been expecting them to this year, which is seeing growth, not really doing an awful lot. We're going to see some plus numbers, we're going to see some negative numbers. We're not going to be seeing 8% growth anywhere. We're not going to be seeing any contractions of 5% anywhere. And the numbers are pretty much borne out. We've got the US GDP on Friday. That came in at what some saw as a disappointing 1.1% versus 2% expected, down from 2.6% prior. But it's still growth. And some of the components underneath, the spending, sales, that sort of thing, we're looking pretty good still. So, you look at the numbers and think, okay, that's a big headline miss. But when you look at it, could it have been worse? Yeah, it could have been far worse. France came in as expected, 0.2%. Nothing going to start waving your flags about, but it's not negative. Then Germany came
flags if they're French, but
naughty. Then Germany came in with minus 0.1% for the quarter, which was quite significant because the Bundesbank only a few days before that came out with a note saying, oh yeah, we expect positive growth this quarter. So they took a little bit of a slap for their forecasting prowess. Italy and Spain were probably the bright spots out of those numbers. Coming in Spain, 0.5%, that was versus 0.3 expected. Italy the same, 0.5 versus 0.2 expected, so a little bit higher than the rest. The Eurozone as a whole came in at 0.1%, so just above flat, and that was a slight miss on the 0.2% expected. So, yeah, as I say, growth, I expect to do this sort of thing all through the year. Nothing's going to be spectacular, but nothing's going to be spectacularly horrible about it either. And that's going to keep the central banks moving in the way that they are. But it's going to be a fine balancing act. If inflation remains sticky and they're staying hawkish of that, but we do start to see some really poor numbers coming into the GDP. We start seeing some negative 1%, negative 2%, that sort of thing. Then the market and the central banks are going to start to be thinking, okay, we're fighting inflation here, but now we're seeing growth dropping dramatically. We need to perhaps look to do something about that. And then that's going to throw the cat amongst the pigeons and all those rate cut calls.
Yeah, absolutely. I think it's interesting, as you say, growth is it's not worth celebrating, but it's growth. And of course, 3 months ago, we were sat here going, when are we going to get a recession? Is it going to be the Eurozone? Is it going to be the UK? Is it going to be the US? Who's going under first? Is there opportunity in Asia, et cetera, et cetera, et cetera? And I think that reassessment of expectations and the subsequent repricing that we've seen in the markets is actually where the trading opportunity comes from in all of this. It's the fact that, things are not great, but they're not as bad as we expected them to be. And that's why currencies such as the pound, for instance, I've been bearish on cable for quite some time now, as people will know. But the fact that the economy has managed to surprise, even compared to those very, very low expectations, is one of the reasons why we see cable trading just north of 125 when I checked Bloomberg just before coming in to do this recording, is because you've got to remember this is relative to where we thought things were going to be. We're actually doing very, very well. On its own, no cause for celebration, of course. But I think the other thing to bear in mind is actually on your point about central banks loosening policy. Of course, most central banks, if you look at the BOE, the ECB, the Bank of Canada, Reserve Bank of Australia, whoever, their mandate is 2% inflation, give or take. There's some tweaks around that. The Fed have a dual mandate. The Fed's mandate is maximum employment and stable prices. And I think that's where the growth argument really comes in, because the Bank of England, the shambles that they are, have been quite clear, I think, in their forecast that if it takes a recession to get inflation under control, they're happy to do it. And their mandate, of course, lets them do it. Can you say the same thing about the Fed? I'm not too sure.
No, I don't think so. And we've got to be careful. The market likes to get into a hoo-ha about recessions. A technical recession is a couple of quarters of negative GDP. And if those negatives are 0.1%, 0.2% for 2 quarters running, that's not a complete collapse of an economy, as much as the press, particularly in the UK, will paint it as such. So until we see real activity dropping off, and that's when you start getting into proper recessionary fears. The markets or the central banks are going to go, okay, GDP isn't great, but the jobs market's still ticking along, wages are still going up, inflation's still steady, there's certain parts that are still working, house prices, housing markets, and they're going to brush it off pretty much, but it's only if we see some real steep contractions and real problems picking up, that's when central banks will start looking the other side.
Absolutely. Well, let's get into some charts in That's a Setup. And yes, I did almost forget the name of a segment on my own show. Really good start this morning. The S&P 500, let's see if we can talk more knowledgeably about that than we can about the segments in this show. Of course, this was my play of the day last week, so I do want to take a little bit of a victory lap. As we said, dip buying down into that 4,100, 40.50 level seems to have worked. The market had a little bit of a trip lower, but the bulls have been helped along quite well by some decent enough economic data, and of course, some very, very solid earnings last week. Microsoft, Google, Meta, all coming in and surpassing expectations. Amazon taking a little bit of the shine off of things with some poorer than expected guidance for Q2, particularly from their web services unit, but the S&P largely shrugging that off and having a very, very nice rally indeed into the end of the week. And it's really now decision time. We're at 4,200. We touched 4,200 and got just above it yesterday for the first time since the 2nd of February. And of course, this marks, as near as makes no difference, the top of the year-to-date range. So it's now a question of, can the bulls really extend their gains and push price through this level, get a closing break here, and then we'd obviously look to the highs that we had last summer around 43.25. And then the other question is, are we going to run out of steam? We saw this in February. We had that big run higher in the first couple of months of the year. We had a hawkish surprise from the Fed, or what the market took as a hawkish surprise at that point, and we came all the way back down to the bottom of the range once more. So it's an interesting position. Personally, I still favor playing things from the long side at the moment. You've got to remember volatility remains low, and the VIX is trading at its lowest levels since last November, as we said last week. That entices a little bit more institutional money to come into the market. But I think there's really 2 key things to watch here. One is, what do the Fed do on Wednesday night? And the second is, what do Apple do in their earnings report on Thursday night? And that's going to be the key driver of whether the bulls can really start to flex their muscles and get some of the shorts to capitulate on a closing break of 4,200, or whether this is February all over again and back down we go. What are your thoughts, Ryan?
Yeah, we've been watching the earnings dropping, and there's been no real stinkers coming out of it, and I expected stocks to do a bit better than they had done. It's only the last couple of days that we actually saw the S&P rallying back up again. We were getting plenty of earnings coming out, and it was still dipping. That might have been a bit of month end going on in there. We don't know. But yeah, I think it's going to take something to break this range. And when you're coming down, and we've spoken about volatility, when volatility is coming down, that's when the ranges can be a bit more sticky. You've got to think that everyone and his dog are looking at this 4,200 level. So there's going to be some decent stops sitting above there. So from a trading standpoint, yeah, we trade the level. It's a good resistance level. So, you can be happy, have a decent conviction going with shorts there. But if you get a break, that's what you've got to be careful of, because a break is potentially going to have some legs, and we could be seeing 43 not long after if we do get a break. But yeah, I've been surprised that it hasn't actually gone higher with these better numbers. But again, it shows the market isn't seeing anything particularly bad coming from economies. Even with a falling growth, we're still seeing good earnings. And while we get those, the market's going to be buoyed by that.
Yeah, it's that expectation story again. It's that relative expectation story. The market was expecting earnings growth to fall quite significantly and expecting a bit of a poor reporting season. No one has really blown the doors off things, but they've been better than expected, which is why the market is reacting favorably, as you rightly say. I think you want to do a little bit of a celebration about your play of the day as well, don't you, right?
Well, yeah, celebrations maybe a little bit highbrow there. You know, we like to know the winners, but we also like to make mention of the losers. So they're not always right. But this one has been a continuation from my play of the day last week, which was dollar China, which we were looking for a break above that 691, 692 level, and we got it. And I managed to get in some longs, which I'm still sitting in and been chopping on the way up, taking some profit on the table. I still think there's some decent mileage in this one, maybe up to that 7 level, which is always going to be a big level. So this one I'm going to be watching for a bit of a continuation. We've got a bit of traffic here around the 695s, 96s. So if we get through that, that might give us another kick on right up to that 7 level. If we get up there, I'm going to be looking to take a good chunk of my longs off there because I say 7 is always a big level, whether it's resistance, whether it's support. You've got to always look at that one. And maybe even depending on the price action, even perhaps looking to turn short, depending if we get any official chatter coming out. Because the one thing I like about this pair is that if it has some big, decent moves, officials will come out and speak about it. Now, they'll either say, yep, it's not a problem, and then that gives the move some extra impetus to continue on the direction it's going. Or they may come out and say, well, we're a bit worried about this move, or don't expect this move to last too long. It's a very good indicator that, okay, enough's enough. The officials, PBOC, whoever, are keeping an eye on the FX rate. And when they comment like that, that's usually your signal to say, right, enough's enough, get out and maybe look to go the other way. So for now, yeah, this one's had a decent break. It's held the break, hasn't really tested the break point significantly. And, it's made a secondary move up. So happy to stay in this one alongside.
Yeah, I couldn't agree more, to be honest with you. I think your latter point is really interesting. The fact that this has been a pretty chunky move that we've seen in dollar China, and the Chinese haven't really had anything to say about it, which the implication of that is, as you rightly say, they're relatively comfortable with the move. And I think this is a pair more than most that when it starts to move and when it starts to get a little bit of a trend, particularly if the PBOC or the fiscal authorities in China don't really show much sign of wanting to lean against it, I don't think that we should be leaning against the trend either.
No, exactly. And, I've had this chart. I've spoken about this one a few times on this show. Been waiting, been saying, if you get a break, go with it. And, these sort of trades, you've got to put in the back of your head, stick it on a Post-it note on your desk or whatever. Keep an eye on this one, see what it's doing, look at the price action. Because when you do get a move, they can be significant, especially when something breaks. But yeah, I think it was last year we were trading this one at Forex Analytics on the long side, and it was when it was rocketing up through 7. And I think it was the banking regulator came out and said, don't expect these one-way moves to last for too long. Boom, that was a top. And everyone just scrambled to get out because you get that signal, you know what to do with it.
Absolutely. Right, let's stay in Asia with the yen. Of course, we had UEDA over at the Bank of Japan, his first decision on Friday. It was an interesting one. I know you were awake for it, Ryan, and mocking me that I woke up exactly as the decision crossed the wires, which, I would say that's perfect timing. But I'll let viewers decide whether they will agree and buy my excuse there or not. And the market took that decision as pretty dovish. Obviously, all policy settings remained unchanged. And I think what the market was really focused on was this policy review that the Bank of Japan announced. And where this disappointed traders was the fact that it's going to take 12 to 18 months for this review to be conducted. Personally, I can do it in about 5 seconds. You did QE for a while, you did negative rates for a while, you've done yield curve control forever. None of it's really worked, and it's probably time to get rid of most of it. There you go. Not sure why it's going to take them 18 months, but I suppose these PhDs have to earn their salary somehow. I think the market is probably focused on the wrong thing here, though, to be honest with you. And you picked this out very, very, very well on Friday morning in the early hours. Clearly had your Weetabix that morning. And that is that the Bank of Japan have dropped the easing bias from their statement that they've had in there for quite some time. And I think the market's got to take that as a bigger sign than it has. And the other thing is, when you look at UEDA's press conference, he was very clear in saying that just because we're doing a policy review, it doesn't mean that we can't change policy in the meantime. So I am tempted to fade some of this yen weakness that we're seeing. The problem with that is that when you then look at the chart, the fundamentals all sound good. The market's got it wrong on what the Bank of Japan are thinking and likely to do. But when you look at the chart, it's really telling you that actually dollar yen bulls are starting to run away with things. We've broken above the 137 figure. We've broken above the 200-day moving average, both for the first time since early March, late February, early March. And this is actually a big level that we've now closed above. And I think 137.65 is the line in the sand for me. If the market moves on a closing break of that level, which is the green line you can see on the chart there as resistance, then we could really start to see the yen move higher, the yen move lower, sorry. I can't help but thinking this is one to fade, but I just got to wait for the right level for it, I think.
Yes, well, talking about dollar China and how that trade's going well, here's one that's not going so well. I'm in shorts in this. I've been short since 132, been adding to that position as well. I have been keeping it very small because I have been saying I've been expecting this move if the Bank of Japan was dovish. So it's going as expected, but not the way my position wants it to go. But this is one of those trades, as you say, where sometimes you have to wonder, have you got deep enough pockets to stay in a trade? Yes, I thought there was plenty that moved the Bank of Japan closer than they've ever been to ending this easy policy, and the market has ignored it. So for my positioning, I'm wondering, okay, this could go a lot further than I want it to go as far as my P&L is concerned. My level's 138 really on this one, which you can see just above your line. We've had those series of little spikes above it. To me, that's the bigger area. I've had it as a bit of a range, 1,000 pip range, 127, 128 to 138. That's going to be the big test for me. If we break above that, I'm going to be worried about my position and whether to get out of it. But also it means this could have some significant legs, and the market isn't yet ready to jump on those comments and those changes from the Bank of Japan. I think a bit of this is the Fed with that data, with that employment data, with the inflation data. The market's moved from the Bank of Japan to the Fed. It's all about the dollar for the moment. So if the Fed stay around what they've been doing previously, we could see the market saying, right, hike's done. They're not going to go much higher. We may find a top here, but it's going to be very interesting if we get to that 138.
Absolutely. Certainly one to have on the radar. Lastly for this segment, what about crude?
Yeah, crude oil. And we like to come back to this one. And, when we looked at it last time, we were trading down the bottom of the range, down at the low 72s, looking at potential longs off there, but also bearing in mind if you get a break, that's something to maybe switch into a trade there. We got a decent move there, $8-9 below that level around 72. Then we had this big jump up all the way to the top. 82.50 was the big area. We got a little test up there, got a few cents through that, and it's done a reverse again. So this one almost looks like dollar China, where we've had a decent consolidation period going on for several months now, and there's no real signs that it's going to break significantly out of those ranges. And when it does, it doesn't last long. So there's a good chance that this low 72s is going to show up as support again. One of those things where an old level we haven't been to for some time shows up again. But it's going to be one where you have to think, okay, need to see the price action here. So maybe looking at longs into that 72 handle, keeping it fairly tight. If you get another break, then maybe we're moving down to those lows again, mid-60s. Things to look at for this one is wobbles in places like China, in manufacturing around the globe. So, we've had the PMIs out from China, and again, they're not looking too hot on the manufacturing side. That's going to be something for commodities in general. So keep an eye on the global manufacturing picture for this one. If it is looking significantly weaker, maybe we're going to go through those 72 lows and have a retest of those low 60s again.
Yeah, very much so. I think, as you can see quite clearly on the chart there, we've closed the gap. We had that big gap higher, a few weeks ago when OPEC announced those surprise output cuts, and the market has excuse me, once again, closed that gap very, very quickly, actually. Once we broke below that $80 a barrel mark, it was really one-way traffic. And I think the message here from the market is one of basically saying to OPEC, you can cut supply as much as you want, but if demand isn't there, then it's really not going to have much of an impact on the price. And I think that's why watching that data that we're getting out of China, watching the manufacturing PMI numbers as they come in from Europe as this week progresses in particular, and also from the States. Obviously, we had the data out yesterday. That is going to be the key driver here. And of course, you've got the FX proxies, the CAD, the NOK, that you can also play that through as well.
Yeah, very much so. As you always say, keep your eyes on the data.
Indeed, yeah, data dependent. We are like central bankers, I guess. Cool. Well, let's get into our plays of the day. So I want to look at the Nasdaq this week. It's not something I would usually select as a play of the day. I normally like US equities through a broader index like the S&P 500. But if you look at what's leading the S&P 500 and also the amount of articles that are coming out about this, the market's becoming very, very concentrated indeed. The vast majority of the gains that we're seeing are coming from the tech sector, from the FANGs, and from NVIDIA in the mix as well. So I'm liking long risk here, and actually, why not do it through the most tech-heavy index that is out there, particularly when the Nasdaq is working on a break of this 13,300, 13,310 level that has been the top of the recent range for some time. If we get a closing break of that, then I'd be looking to go long and targeting the two levels that are marked above. And again, I think equities are a buy on dips here at the moment into that support just below 13,000. If we get below that, then I'd be looking to get out. Of course, this is, this week at least, in the very, very short term, a play on what the Fed do and a play on Apple earnings. A hawkish Fed and a miss from Apple are the two big risks to this trade. But for me, I think long tech, long Nasdaq is looking very interesting indeed at the moment. Ryan, what about the Aussie? Obviously, that surprise overnight.
Yeah, a bit of a surprise. Got me with a Tipex out this morning on the plate. So I was going to be looking at longs off the bottom of the range, but instead I'm going to look at the other side. You know, that's the beauty of being a trader. You know, I'm not beholden to any bank clients. I don't have to make a prediction and stick with it for 6 months. I can flick like a light switch as conditions arise. So they surprised me with a 25 pip hike, and we've gone, as I say, from a potential test of the low end of the range to now potentially a test of the high end of the range. That comes around this 68 handle. And, you know, with the FOMC in focus as well, you know, we're going to move to the dollar side of the trade. And that's potentially going to maybe put the brakes on this move in particular. I think there's a bit of mileage to see some further upside here, but 68 is my level there. So that's something I'm going to be looking at for shorts. It's going to be a bit of a smash and grab trade, though. If we hit that 68 and it holds, if we get a dip, even, you know, 15, 20 pips, I'm going to be looking to take a good chunk of profit off of that. Just let the market do its thing. Just maybe keep a piece on to let it run, see how far it will go. But it's going to be with a very tight stop if I do that. You know, over 68, 20, 30, I'm going to be gone. But yeah, this is one I think would probably be a stretch point as far as the RBA goes. So keep an eye on that, the price action today. And yeah, as I say, I'm going to be potentially looking at shorts into that 68.
Good stuff. Well, that brings us to the end of another show. Thank you, as always, for watching. It is an absolute monster week ahead, so I'm sure we're going to have plenty to talk about this time next week. Thank you, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me, and also to our producer, Kyriakos, for bringing this together as brilliantly as he does every week. If you've enjoyed the video, leave a like, drop a comment, let us know how you're trading the markets, and if there's anything you'd want us to discuss. And all three of us will be back again this time next week. Thanks for watching, and goodbye for now.